Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm Sophia, and today we are diving into a topic that affects every single one of us, whether you're actively trading the markets or simply managing your household budget. We are talking about why inflation feels worse than the data suggests, and more specifically, the gap between inflation perception versus reality. If you've looked at official inflation numbers recently and thought, there's no way it's only 3%, you're not alone. Many people feel like their cost of living is rising much faster than what government reports show. Groceries feel more expensive. Rent feels heavier. Insurance premiums creep up quietly. Dining out costs more than it used to. And yet, headlines might say inflation is cooling. So what's going on here? Is the data wrong? Or are we missing something deeper? Let's unpack this carefully. First, we need to understand how inflation is officially measured. Most countries rely on metrics like the Consumer Price Index, often called CPI, or the Personal Consumption Expenditures Index, known as PCE. These indicators track price changes across a broad basket of goods and services that are meant to represent the average household. This basket includes housing, food and beverages, transportation, medical care, education, recreation, apparel, technology, and more. Each category is assigned a weight based on how much the average household is estimated to spend in that area. And here's where the first disconnect begins. There is no such thing as an average household. Your spending pattern is unique. Mine is different. A retiree's looks different from a young professional's. A family with 3 kids has completely different financial pressures compared to a single person working remotely. So while CPI might show inflation at 3%, your personal inflation rate could feel like 7% or 8% depending on what you spend your money on. Let me give you a clear example. Imagine 2 households. Household A owns their home outright, works remotely, and barely drives. Household B rents in a major city, commutes daily, and has 2 children in daycare. If rent rises sharply, fuel costs spike, and food prices increase, Household B is going to feel a significant squeeze. Household A might barely notice. Yet both households are reflected in the same national inflation statistic. This is a core issue in the inflation perception versus reality debate. The data reflects averages. Your life reflects specifics. Housing is a particularly important example. Shelter makes up a large portion of CPI. But the way housing costs are calculated, especially for homeowners, includes something called owner's equivalent rent, which attempts to estimate what homeowners would pay to rent their own home. This calculation often lags real-time price changes. Renters might experience a sharp 10% increase when renewing a lease, but the official data may reflect that increase gradually over time. So there's a timing mismatch between lived experience and reported data. Now let's move into psychology, because this is where things get even more interesting. Humans are wired to react more strongly to losses than gains. Behavioral economists call this loss aversion. If your grocery bill goes up by $50, that feels painful. If your streaming subscription drops by $10, it barely registers. Inflation is essentially a series of small losses. Each time you pay more for something you used to buy at a lower price, your brain compares the new price to the old one. That comparison triggers discomfort. You may not remember last year's CPI number, but you absolutely remember that eggs, milk, or gasoline used to cost less. And those repeated comparisons reinforce the feeling that inflation is out of control. Frequency also plays a major role. You buy groceries weekly. You check gas prices frequently. You pay for food, coffee, transportation constantly. These are high-frequency purchases. Now compare that to buying a television, a refrigerator, or a laptop. Those purchases happen rarely. Even if technology prices fall due to innovation, you don't experience that often enough for it to meaningfully influence your perception of inflation. High-frequency price increases dominate your financial consciousness. Another key factor is wage growth lag. Even if wages eventually rise in response to inflation, they often lag behind price increases. During that lag period, households feel squeezed. If inflation rises 5%, but your salary increases only 2%, you have effectively lost purchasing power. That gap is real. It creates financial stress. Even if inflation later slows down, the squeeze you felt during that period shapes your long term perception. And inflation does not hit all income groups equally. Lower income households spend a larger percentage of their income on essentials like food, rent, energy, and utilities. When those categories rise sharply, the impact is immediate and intense. Higher income households spend more on discretionary services, travel, and investments. Their inflation experience may look very different. So, when we talk about inflation perception versus reality, we also have to acknowledge distributional differences. Aggregate numbers can hide very real pain at specific income levels. Let's talk about media influence for a moment. Inflation headlines are powerful. Gas prices surge. Food costs jump again. Central bank battles inflation. These narratives stick. Even if inflation is trending downward, emotionally charged headlines amplify anxiety. Social media reinforces this by spreading personal stories about price hikes. When you see dozens of people sharing similar experiences, it confirms your own perception. Narratives shape expectations, and expectations influence economic behavior. If people expect prices to keep rising, they demand higher wages. They may accelerate purchases. Businesses may raise prices preemptively. Expectations can become self reinforcing. Now, here's another subtle but critical point. When inflation falls, prices are not falling. They are simply rising more slowly. If inflation drops from 8% to 3%, prices are still going up. They just aren't rising as fast as before. Consumers often interpret falling inflation as prices returning to previous levels. When that doesn't happen, frustration builds. This misunderstanding plays a huge role in the perception gap. Structural changes also matter. Some price increases are cyclical, others are structural. Housing shortages, rising healthcare costs, insurance premiums, and education expenses can trend upward over long periods. These increases don't feel temporary, they feel permanent. Permanent increases reshape how people view their long-term purchasing power. Now, from a trader's perspective, why does all this matter? Because perception drives behavior. When inflation feels high, investors tend to seek higher returns. They may move capital into equities, commodities, or assets perceived as inflation hedges. They may reduce cash holdings. They may reassess portfolio allocations. Understanding the difference between inflation perception versus reality helps you avoid reactive decision making. It helps you separate emotional responses from data-driven strategy. If you want to actively navigate changing economic conditions with confidence, having the right tools matters. A powerful, cutting-edge, user-friendly trading platform can make all the difference. You can explore Crystal Ball Markets' world-class platform at crystalballmarkets.com/platform. It's designed to help traders analyze market trends, monitor macro shifts, and position themselves strategically in environments shaped by inflation dynamics. Education also plays a crucial role in reducing financial anxiety. The more you understand macroeconomics, central bank policy, and market cycles, the less overwhelming inflation headlines become. If you're looking for clear, beginner-friendly discussions on trading, investing, macro trends, and financial markets, I highly recommend checking out the Crystal Ball Markets podcast at iss.com/podcast/crystalballmarkets. Continuous learning is one of the most powerful tools you can have as a trader. So let's bring this all together. Inflation feels worse than the data suggests because your spending isn't average, because you notice frequent purchases more than rare ones, because psychological loss aversion amplifies price increases, because wage growth lags behind price spikes, because media narratives reinforce fear, because structural costs feel permanent, and because slower inflation doesn't mean lower prices. Your feelings about inflation are valid, but understanding the mechanics behind inflation perception versus reality gives you clarity. And clarity is a competitive advantage. As traders and investors, we don't just respond to data. We interpret sentiment. We analyze behavior. We anticipate reactions. When you understand both the numbers and the psychology behind them, you operate at a higher level. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode, where we continue breaking down the forces shaping global markets and helping you trade with insight, not emotion.